I'm Charlie Munger, and I'm about to tell you something that will make a lot of people in the financial services industry extremely angry with me. Probably, if they hear it, they'll wish I'd shut up forever. But I'm 99 years old. I've been investing for over 70 years, through every crazy market cycle, every bubble, every crash, every scam packaged in a fancy sounding name. I've accumulated billions of dollars in wealth, and at this age, I no longer care about being polite or diplomatic. So let me say it plainly. No hedging, no sugarcoating. The financial services industry has been lying to you for decades. Not just a little, but systematically, sophisticatedly, repeatedly across generations. They've convinced you that investing is so complex, so difficult, so dangerous that without them, you're almost certain to make mistakes, lose money, and ruin your future. They've made you believe you need professional help, that you must have a financial advisor to manage your money, because you're not smart enough, not educated enough, not experienced enough to do it yourself. And that lie, that foundational lie alone, has cost the American public trillions of dollars in unnecessary fees, commissions, hidden costs, and lost returns that should have been yours. I'm going to expose exactly how this lie works, why it's so destructive, and what you should do instead if you want to become truly wealthy rather than just looking taken care of. And I need to warn you, if you're currently paying a financial advisor to manage your money, what I'm about to say will make you very uncomfortable, maybe even shocked. You'll probably realize you've been deceived for years, maybe decades, by a system designed to suck financial blood from your ignorance. But that discomfort is necessary, like lancing a wound to drain the pus. It's the first step to truly taking control of your financial future and building the wealth you deserve, instead of continuing to fatten an industry that lives on fees. Let me start by telling you a story from my own life. A story that taught me this lesson pretty early. Back in the 1960s, when I was still practicing law and just starting to build my own portfolio, I had a broker at a big Wall Street firm. This was a respected guy, sharply dressed, spoke with confidence, worked for a well-known company, recommended by other lawyers I knew. He'd call me regularly with stock tips, hot recommendations, rare opportunity, ideas about what I should buy and sell. And like most people, I trusted him at first. He seemed knowledgeable, spoke smoothly, used a lot of sophisticated sounding language, full of financial jargon. He had access to research reports I didn't, to analyst teams, to insider information he always hinted at. So I followed his advice for about 2 years. I bought what he recommended, sold when he suggested, paid him commissions on every trade, and after 2 years, you know what happened? My portfolio basically went nowhere. It was up maybe 3 or 4% total over 2 years, barely enough to keep pace with inflation, definitely underperforming the overall market if I'd just bought an index fund. But here's what really opened my eyes. I started calculating how much I'd paid in commissions and fees over those 2 years. When I added it all up, I realized I'd paid this broker over $7,000 in commissions. That was a huge amount in the 1960s, equivalent to a very substantial sum today. $7,000 for advice that basically produced no returns for me. Didn't make me much better off, but guaranteed income for him, no matter the outcome. And that's when I realized the fundamental problem with the financial services business model. The lie isn't that all financial advisors are bad people trying to steal your money, though some certainly are. The lie is far more sophisticated, far more legal, and therefore far more dangerous. The lie is that their interests are aligned with yours, that they make money when you make money, that they're on your team, that they're working for you, protecting you. But the truth is the complete opposite in most cases. Financial advisors make money from fees and commissions, whether you make money or lose money. In fact, in many cases, they make more money when you do things that hurt your returns, because those things generate more trades and more products. Let me break down exactly how this works, because most people don't understand the incentive structure of the financial services industry, and that ignorance is costing them a fortune over a lifetime. When you work with a typical financial advisor, there are usually a few ways they make money off you. First is the asset management fee, what they like to call fancy names like portfolio management fee or assets under management, AUM fee. Usually 1 to 2% of your total portfolio value every year. Sounds small, just 1%, no big deal. But in reality, it's devastating to long-term wealth accumulation when compounding is at work. Let me show you the math. If you have $500,000 invested and you're paying 1% fee, that's $5,000 a year, year after year, for 30 years, assuming reasonable market returns. That 1% fee will cost you about $400,000 in lost future wealth. Not just money paid out, but compound interest you never get. $400,000 to have someone manage your money, while I'll show you that you can do better yourself, simpler, less stressful, and keep all that money. But it gets worse, because many advisors also earn commissions from the products they sell you. They'll put you into actively managed mutual funds that pay them kickbacks. They'll sell you insurance products wrapped in investment vehicles that generate big commissions. They'll recommend annuities that lock up your money for years and pay them hefty fees. And here's the really insidious part. All of this is technically legal. It's all disclosed somewhere in the fine print nobody reads, written in legalese. But it's fundamentally corrupt in incentives because it creates a system where the advisor profits from giving advice that may or may not be in your best interest. Let me give you a specific example so you see it clearly. A financial advisor could recommend putting your money into an actively managed mutual fund that charges 1.5% a year and pays the advisor a commission. Or they could recommend a low-cost index fund that charges 0.03% a year and pays the advisor nothing. Which do you think they'll recommend? Obviously the one that makes money for them, not the one that's better for you. And they'll justify it with sophisticated sounding language about active management, professional stock picking, superior alpha, beating the market. It all sounds great in a presentation slide, but it's almost never delivered sustainably. Study after study shows that over long periods, 90% or more of actively managed funds underperform simple low-cost index funds, especially after fees and trading costs. But financial advisors keep recommending these high-fee products because that's how they get paid. This is the core lie. They're not really working for you. They're working for themselves, for their firm, for their fee structure. And you're paying for the privilege of getting advice that makes you poor and them richer. Now, let me address what I know you're thinking, because people always push back the same way when I explain this. They say, Charlie, but I'm not a professional investor. I don't understand the markets. I don't have time to manage my money. I need professional help. And I'll tell you the same thing I've told everyone for 60 years. That's exactly what the financial services industry wants you to believe. And they've spent billions of dollars planting that idea in your head. They've spent billions on marketing and advertising, convincing you that investing is unimaginably complex, that you need expert help, that trying to do it yourself is dangerous, foolish. But it's not true. Investing is actually very simple if you stick to basic principles and avoid doing stupid, impulsive things. The irony is, by keeping it simple and avoiding expensive expert financial advice, you'll almost certainly do better than paying for their help. Let me prove it to you with some very simple numbers. If you just put your money in a low-cost S&P 500 index fund and hold it for 30 years, you'll beat about 90% of professional money managers over that time. And you'll save hundreds of thousands of dollars in fees you'd pay those managers. You don't need any special knowledge, no sophisticated analysis, no network or inside information, no professional advice. You just need to buy an index fund and leave it alone, contribute regularly, and be patient. That's it. But that advice doesn't generate fees for the financial services industry. It doesn't feed the ecosystem of advisors, brokers, product sellers. So they'll never tell you to do it. Instead, they'll tell you you need active management, that you need sophisticated strategies, that you need their expertise, that you can't handle it yourself. It's all self-serving nonsense designed to extract fees from you. Let me tell you about a study, I believe from the early 2000s, that illustrates this problem perfectly. Researchers analyzed the returns of thousands of individual investors who managed their own money versus those who used financial advisors. And what they found shocked a lot of people. but not me. But individuals who managed their own money on average generated higher returns than those who paid for financial advisors, even though the self-managed investors had no professional training or certifications. How is this possible? Two simple reasons. First, self-managed investors don't pay 1 to 2% annual fees, so they keep more of the returns. Compounding does the rest. Second, and this is crucial, self-managed investors tend to keep things simple and trade less frequently. They buy index funds or solid dividend-paying stocks and hold them for the long term. On the other hand, investors with financial advisors often have portfolios that are constantly churned, buying and selling, moving money, restructuring, optimizing strategy, generating fees, commissions, and taxes, all of which destroy returns. Professional advice is worse than no advice at all, because the advice is designed to generate fees, not to maximize your returns. This is the dirty secret of the financial services industry that nobody wants to talk about. In most cases, you're better off doing it alone than paying for ongoing advice. Now, let me give you my framework for when, if ever, you might actually need a financial advisor. Because I'm not saying nobody on earth should ever use one. I'm saying 95% of people don't need and shouldn't pay for one. So, when might you actually benefit from professional financial advice? If you have an extremely complex situation, if you own multiple businesses, if you have complicated estate planning needs involving multiple trusts and generations, if you have tax situations requiring sophisticated planning across different jurisdictions, then yes, you might benefit from hiring specialized experts. But note, I said specialized experts, not a generalist financial advisor who knows a little about everything. You want a tax attorney for tax planning, an estate planning attorney for estate work, maybe a CFP, but only the hourly fee kind, for specific planning questions. And you want to pay them by the hour for their expertise, not give them a percentage of your assets to manage forever. For most people, your situation isn't complex enough to require any of this. If you're a professional earning a good salary, saving money, investing for retirement, preparing for kids, your situation is actually very simple in principle. Even if it feels complex to you, you just need to do a few basic things. Maximize contributions to tax-advantaged retirement accounts. Invest those contributions in low-cost, diversified index funds. Hold those investments for decades without touching them, without jumping in and out based on news. Keep 6 months of living expenses in cash for emergencies and avoid debt, except for a reasonable mortgage on your home. That's it. You don't need a financial advisor to tell you these things. You don't need sophisticated strategies or complex products wrapped in fancy names. You need discipline and patience. And those things, unfortunately, you can't hire someone else to do for you. Anyway, let me tell you what I did with my own money over the years, because I think it illustrates the principles I'm teaching you perfectly. After firing that broker in the 1960s, I never worked with a financial advisor again. Ever. I managed all my own investments for the next 60 years, and I became a billionaire. Now, obviously, I had advantages you don't. I worked closely with Warren Buffett. I had access to opportunities most people don't. I'm not suggesting you can replicate my exact results, but the principles are the same. I kept it simple. I invested in businesses I understood. I held for very long periods. I didn't trade frequently, didn't chase rumors. I didn't try to time the market. I didn't pay fees to middlemen unless necessary. Simple, disciplined, patient investing, that's what works. And you can absolutely do it without paying anyone a percentage of your assets. Let me give you a specific example to make this clearer. Suppose you're 40 years old. You have $200,000 saved. You earn $150,000 a year and can save $30,000 a year going forward. You go to a financial advisor and they recommend a portfolio of actively managed funds, charging a 1% annual management fee plus internal fund fees. Over the next 25 years, until you're 65, say, you accumulate $2 million. Sounds pretty good, but here's what happens if you do it yourself. You put the same money into low-cost index funds, charging about 0.1% instead of 1%. The money compounds at the same market rate, but you keep an extra 0.9% a year by avoiding advisor fees for 25 years. That tiny difference on paper means you end up with about $2.4 million instead of $2 million. You just made an extra $400,000 simply by not hiring a financial advisor and not paying unnecessary fees. $400,000 that a financial advisor would quietly drain from you in fees for giving advice you didn't need and probably didn't help you anyway. But it's even worse when you consider what financial advisors often do with your money, because they don't just charge you fees, they often put you into investments that have high fees themselves. So you pay a 1% advisory fee on top of 1 to 2% mutual fund fees. Now you're losing 2 to 3% a year to fees. That's absolutely devastating to wealth accumulation. I can't emphasize this enough. Fees are the silent killer of wealth. Every percentage point you pay in fees is a percentage point you don't earn in returns. Over long periods with compounding, this makes a massive difference. A 2% drag over 30 years will cost you about 40% of your final wealth. You're giving away nearly half your money to financial middlemen who provide very little real value. That's robbery, legal robbery, protected by contracts and licenses, but still robbery. And the financial services industry has done a brilliant job of normalizing this, making people think it's just the cost of investing, that everyone pays these fees, that it's perfectly reasonable. It's not reasonable. It's outrageous, and you should be angry about it. Now, let me talk about the specific lies financial advisors often tell to justify their fees, because understanding these lies will help you resist them when you hear them in real life. Lie number 1, you need active management to beat the market. This is the most common justification for high fees. They'll tell you that their professional stock picking, their research capabilities, their sophisticated strategies can generate superior returns over simple index investing, and therefore their fees are totally worth it. But the overwhelming data shows this is false. Over any meaningful time period, the vast majority of active managers fail to beat the market, especially after fees. Even among the small percentage that beat the market in any given year, very few can do it consistently over many years. It's essentially random, like flipping a coin long enough and bragging about a few streaks. And the winners are almost impossible to identify in advance. So, paying for active management is paying for a service that statistics show doesn't work for the majority. It's like going to a doctor with a 5% cure rate but charging double the normal price. You wouldn't do that in medicine, but people do it with their investments every day because they've been brainwashed for so long. Lie number 2, diversification requires building a sophisticated portfolio. Financial advisors love talking about asset allocation, balancing different asset classes, correlation coefficients, efficient frontiers, and all this complex sounding stuff. Then they'll tell you that creating a properly diversified portfolio requires professional expertise, special software, models, backtesting. This is nonsense. Diversification is important, but achieving full diversification is trivially easy. You can buy a single total stock market index fund, and you instantly own a piece of thousands of companies across all sectors and sizes. That's diversification. If you want to add some bonds, buy a total bond market index fund. Now you're diversified across stocks and bonds. Congratulations. You just built a properly diversified portfolio in about 5 minutes with 2 funds. You don't need a financial advisor. You don't need sophisticated analysis. You don't need ongoing fees. But that simple solution doesn't generate revenue for the financial services industry. So they pretend it's inadequate, that it's not professional, and that you need something more complex that they can charge you for. Lie number 3, market timing and tactical allocation can protect you from losses. When markets are volatile, financial advisors love talking about how they're actively managing your portfolio, moving to defensive positions, reducing stock exposure, protecting your downside. Sounds great. It makes you feel like you're getting value for your fees, like they're working hard to earn the money you pay. But study after study shows that market timing doesn't work consistently. Nobody can reliably predict when the market will go up or down. Advisors who successfully navigate one downturn often fail in the next. It's just luck disguised as skill. And the cost of this active trading, transaction costs, tax consequences, fees, almost always outweigh any benefit from occasionally guessing right. You're better off doing nothing, just holding through volatility, than paying someone to constantly move in and out of the market, hoping to avoid the drop. Lie number 4. You need guidance to avoid emotional mistakes. This one is especially insidious because it contains a kernel of truth, making it more believable. It's true that individual investors often make emotional mistakes. They panic and sell during market crashes. They get greedy and buy at market tops. They chase performance, buying whatever's gone up the most recently. These are real problems. And financial advisors will tell you they provide value by preventing these emotional mistakes, by being the steady hand that keeps you disciplined. Sounds reasonable. But here's the reality. Financial advisors don't actually eliminate emotional mistakes. They just change the form of them. Instead of panicking about the market, clients panic about whether they picked the right advisor. Instead of chasing stock performance, they chase advisors with better recent track records. And in many cases, financial advisors themselves make emotional mistakes with client money. They're human too. They get scared. They get greedy. The real solution to emotional investing mistakes is education and discipline, not paying someone else to make decisions for you. If you understand basic investing principles, if you commit to a simple long-term strategy, if you accept that volatility is normal and temporary, you don't need to pay someone to keep you from panicking. You just need to stick to your plan. Let me tell you what happened during the 2008 financial crisis, because it perfectly illustrates the lie that financial advisors protect you from emotional mistakes. I knew dozens of people who had financial advisors managing their money. During the worst of the crisis in late 2008, early 2009, when the market was down over 50%, you know what most of those financial advisors recommended? They recommended selling, moving to cash, protecting what's left. And their clients did it. They sold near the bottom, locked in huge losses, and then missed most of the subsequent recovery. Meanwhile, I knew others who had no financial advisor, who just held their index funds through the crash, partly because they didn't know any better, partly because they understood the principle that markets eventually recover. And those people, those without professional advice, ended up far better off because they held through the crash and participated fully in the recovery. Professional advice, which people paid for and trusted, was worse than doing nothing. It destroyed wealth. This isn't a rare exception. It happens repeatedly in every crisis. But people still trust financial advisors because the industry has convinced them they can't manage on their own. Now, let me give you my alternative framework. Instead of paying a financial advisor 1% of your assets every year for the rest of your life, here's what you should do. First, educate yourself on basic investing principles. You don't need to become an expert. Don't need to be the next Warren Buffett. You just need to understand a few foundational concepts. What stocks and bonds are, how they generate returns, why diversification matters, why fees matter so much, how compounding works, why time in the market beats timing the market. You can learn all of this in a few weeks of serious reading. I recommend a few books. The Little Book of Common Sense Investing by Jack Bogle. A Random Walk Down Wall Street by Burton Malkiel. And yes, some of what Warren and I have written about investing over the years. These books aren't complicated. They're written for regular people, not PhD financiers, and they'll teach you everything you need to invest successfully on your own. Second, keep your investing strategy so simple it's almost boring. I can't emphasize this enough. Simple beats complex almost every time. Buy low-cost index funds that track broad market indexes. If you want to keep it extremely simple, just buy a target date retirement fund from Vanguard or Fidelity that matches your expected retirement year. These funds automatically adjust your asset allocation from stocks to bonds as you age. And they charge very low fees, often around 0.1% or less. That's it. You're done. You don't need individual stocks unless you really enjoy researching companies and fully understand the risks you're taking. You don't need complex real estate funds or commodities or international small cap value funds or any of the other complicated things financial advisors will try to sell you to look innovative. Just broad market index funds, held for decades, with consistent contributions from your income. This strategy is boring. It's not exciting. It won't give you cool stories to tell at parties, but it works, and that's what matters. Third, automate everything so you don't have to keep making decisions and don't rely entirely on willpower. Set up automatic contributions from each paycheck into your retirement or investment accounts. Set up automatic investing of those contributions into your chosen index funds. If you have multiple funds, set up automatic rebalancing once a year. The less you have to think about your investments, the less you have to actively manage them, the better you'll do. Because every time you think about your investments, every time you check your balance, every time you read a sensational market headline, you create another opportunity to make an emotional mistake. Automate it, forget about it, and let compounding do its work over decades. This is what truly wealthy people do, by the way. They set up systems that run automatically and then spend their time and energy making more money from their work, building businesses, or doing what they love, not staring at stock tickers. Fourth, if you have specific questions or need help with something particular, hire a fee-only financial planner to answer those specific questions. Pay them by the hour, get the answers, and move on. Don't give them ongoing control of your money. Don't pay them a percentage of your assets every year like a permanent membership fee. Only pay for specific advice when you need it and manage everything else yourself. This might cost you a few $100s a year instead of thousands or tens of thousands in advisory fees. The savings are enormous, and the advice is often better because the planner has no incentive to recommend complex products that generate ongoing fees. They're just paid to think for you for a few hours. That's it. This is how you should think about professional financial advice. Like a service you buy retail when you need it, not like a lifelong marriage you pay for every year, whether you get value or not. Now, let's address the question I know some of you are asking. Charlie, if what you're saying is true, why does the financial advisory industry still exist and even thrive? If they don't provide much value, why do so many smart people use financial advisors? The answer is a combination of brilliant marketing, regulatory capture, and very predictable human psychology. The financial services industry spends billions of dollars a year on advertising and marketing to convince you that investing is complex and scary, and that you need their help. They fund academic studies showing the value of financial advice. They lobby for regulations that make it harder for individuals to access certain types of investments without an advisor. They've built an entire infrastructure of certifications, credentials, and professional associations that create the appearance of expertise and legitimacy. They hang degrees and titles on their walls that most clients don't understand but look impressive. And they exploit basic human psychology, especially the desire to offload difficult decisions to someone else, and the willingness to pay for peace of mind, even when that peace of mind isn't actually justified by better results. People want to believe there's someone smarter watching their money, someone who knows more than they do, someone looking out for their interests. That desire is so strong that people will pay huge fees for it, even when the evidence shows they're not getting commensurate value. It's a brilliant business model for advisors, but terrible for clients. And here's the really twisted part. The worse the economy, the more volatile the markets, the more valuable financial advisors seem, even though they can't actually protect you from economic downturns. When people are scared, confused, that's when they're most likely to pay for advice. Hire a financial advisor. Buy that peace of mind. But that's also when you're most likely to get bad advice, because advisors are human too. They get scared. They don't know the future. The whole thing is absurd when you step back and look at it objectively. But people are so conditioned to believe they need professional help that they don't question it. Let me give you one more specific example to drive this home. I have a friend, I won't name him, who's a very successful doctor, earning over $400,000 a year, who worked with a financial advisor for 20 years. This advisor charged 1% a year and had my friend's money spread across a dozen different mutual funds, each with its own fees, lots of churning, active management, the whole professional package that looked very busy. I looked at his portfolio a few years ago and calculated that he was paying about 2.3% a year in total fees when you added advisory fees and underlying fund fees. 2.3% over 20 years. That ate hundreds of thousands of dollars in potential returns. and I compared his returns to what he would have gotten if he'd just put everything into a simple 3-fund portfolio. Total stock market, total international stock market, total bond market, with allocation appropriate for his age. He would have had about 40% more money. 40%, not 4%. That's how much his financial advisor cost him. When I showed him the analysis, he was devastated. 20 years paying someone he trusted, someone he thought was helping him, and in reality, that person cost him millions and lost wealth. But here's the thing, he's not unusual. This happens to millions of people every day. They work hard, earn good money, save diligently, and then give away a huge chunk of their wealth to financial middlemen who provide very little real value. So, what should you do if you're currently working with a financial advisor? First, don't panic. Don't make any drastic changes immediately, but start asking questions. Ask your advisor exactly how they're compensated. Do they take a percentage of assets? Do they receive commissions from products they recommend? Are there any clear conflicts of interest in how they're paid? If they're not completely transparent about this, that's a red flag. Second, ask them to justify their fees. What specific value do they provide that justifies 1% or more of your assets every year? What returns have they generated for you after fees compared to a simple index fund you could buy yourself? If they can't give a clear quantifiable answer, that's another red flag. Third, calculate exactly how much you're paying in total fees. Add up advisory fees, underlying fund fees, any transaction costs, any other miscellaneous charges. Most people don't know what they're really paying because it's deliberately obscured. But you need to know. And once you know, you need to ask yourself whether that amount is justified by the value you're receiving. And here's the hard truth. For most people, the answer will be no. The fees are not justified. You're paying for something you don't need. And if that's the case, you need to make a change. You need to fire your financial advisor. Move your money to a low-cost broker like Vanguard or Fidelity. Invest in simple index funds. And take control of your own financial future. Is this scary? Yes. Will you feel uncomfortable at first? Definitely. Will you doubt yourself? Probably. But I'm telling you, as someone who's invested for over 70 years, accumulated billions in wealth, seen every kind of investing approach across generations, this is the right move for the vast majority of people. You don't need a financial advisor. You need education, discipline, and a simple low-cost investing strategy. That's all. Let me end with this. The biggest lie financial advisors tell you isn't really just about investing. It's a lie about who you are. They tell you, explicitly or implicitly, that you're not capable of managing your own money, that you're not smart enough, not educated enough, not disciplined enough, that you need them because you can't do it yourself. And this lie is especially effective because it taps into deep-seated insecurities, fear of making mistakes, imposter syndrome, financial self-doubt. But it's not true. You are capable of managing your own money. You don't need special expertise or certifications or insider knowledge. You just need to learn some basic principles, keep it simple, be patient, and avoid paying unnecessary fees to middlemen. If you're smart enough to earn a good living in your profession, you're smart enough to invest your own money. Don't let the financial services industry convince you otherwise. Don't let them drain fees from you for decades for services you don't really need. Take control of your money, educate yourself, simplify, automate, and let time do the rest. If you do that, you'll very likely end up far wealthier than if you paid someone else to take care of you. That's the truth they don't want you to know. But now you know it. And what you do next with that truth, that's what will determine whether you achieve true financial freedom or not.